Hello, ladies and gentlemen. Good to be back again. I don't need to introduce these people. You are in the stock market, you see them every day, and you've seen them for decades right now. Devina, Ridham, Kenneth, and Saurabh, they're all familiar faces to you. Thank you very much, all of you, for joining in today. I'll start with the lady. Devina, every few years we have this thing going up that this is finally India's decade. Do you think this is one more of those, or is this the real thing?
Actually, there are two parts to this. Yes, you're right that 2003 to 2007, for example, when India went up 6 times at a time that US could not come out of its post-tech crash lows, and the whole emerging market index went up 3.5 times. We heard this, that this is the decade, century, what have you, of India, China, BRICS. So the stories follow what is happening in the market. So this time, if you go back a year or a little before that, when I was asked that would India outperform in 2022, I had said yes, clearly it would. And the reason for that was very simple, that it had underperformed for a very, very long time, both relative to global markets and relative to its own history. So if you go from 2010 to 20, that whole decade, India compounded only 8% at a time when fixed deposit rates were 8%, at least for part of the time. As against that long term, since Sensex started and the figure in our mind of compounding 15-16%, we had compounded only 8.5%. So you were coming out of that trough. You were very far below the trend line when that 2020 bull market started. That is one. If you look at relative to the globe, again, most of that decade, out of 42 country indices that are generally tracked, we were 21 one year, 24 another year, 25 another year, basically in the underperforming bucket. So last year when that thing changed and you came into the outperforming bucket, last year in 2021, India was number 13 out of 42, but that proved to be lucky. This year we were number 10. We were still down in dollar terms, almost 5%. But that's against a global market which were down 18 and odd percent. S&P about, again, down 18 and odd percent. NASDAQ down a lot more, among the worst performing markets in the world. So once that kind of trend change comes, it continues. So India likely to be an outperformer. We can make whatever story out of it that we want. And the risk of the crash is, again, less when you are not even at the trend line. So those would be my comments on India. The narrative, always you can make it as fun as you want, especially in the media.
No, man. The person who makes it the most fun is Ridham. His reports are unambiguously the most bullish about India. So Ridham, I must ask you, is this hype or is this the real thing?
No, it is the real thing, Udayan. So first of all, let's get the facts right. Okay, over 5, 10, 15, 20, 25 years, India has been the second fastest growing economy in the world. Over 5, 10, 15, 20, 25 years, and I don't like 1-year time frames because equity market should not be done for 1-year time frames, so I prefer these 5-year blocks. India has been amongst the best performing stock markets in the world. It is joined by only 2 other markets. And it's been top 5 for each of these time frames, Denmark and US. In US dollar terms, on a 25-year time frame, India has beaten the US stock market by 40 basis points in compounded dollar returns. So this has been a stellar stock market. Yes, of course, there have been periods when the market has not done well, specifically the period that Devina referred to, which was, I think, somewhere between 2011 and 2015, which was a tough period because inflation was high and we had to take a lot of measures and our macro balance sheet was not looking good. But things have changed dramatically in the last 7-8 years. India's macro stability is the best that it has been in my memory and my 30 years in the stock market. India's growth is finally, approaching potential. And the most incredible thing that's happening here is that the gap with the world is widening. So the world is looking quite murky. And therefore, on a relative basis, I think, most people will, whether it's a corporation trying to invest for for profits and revenues or whether it's investors, India is going to be a favorite destination. So, yeah, to answer your question, is this India's decade? I mean, we wrote a report in November, which is titled Why This is India's Decade. So there you have the answer.
Okay. Saurabh, you've been on both sides, the buy side and the sell side. Is this sell side talk or do you buy it?
No, so look on both sides, right? On both sides, I have benefited, and I suspect many people in this panel and in this room have benefited from the myopia. I think that Ridham beautifully picked up. It's bizarre, actually. I think Ridham's numbers are bang on. And just to sort of put it in a different way, in India, if you take the 20-year dollar return, Nifty TRI, it's I think 14.2%. It's the second best in the world amongst large markets. But even if we didn't benchmark it, even if we didn't say whether it's second best or third best, if I told you, we told anybody else in the rest of the world that India does 14.2% total return US dollar over 20 years, I think the 10-year number is $8.5 returns. These are very good numbers, right? So on both the buy side and the sell side, I had a relatively easy job on the sell side. I have a relatively easy job on the buy side because we tend to tie ourselves up in knots about the economy, about market kahan ja raha hai, needlessly so. And because we tend to tie ourselves up in knots for no good reason, right? We tend to tie up ourselves in knots for no good reason. We sell good companies, we sell the Indian market, so does the foreign investor. So does the foreign investor who also gets caught in this kind of wild frenzy of pessimism that we push ourselves into from time to time. And that creates valuation anomalies. Right? As a broker, I tried to make money from it. It's far easier actually to make money from it from an investor. Let me flip it and give you the other side of the coin. The country which has played this game the best of revving up non-stop positive publicity. Right? It's the world's most populous country for a few more years, I guess. It's a country whose market compounds dollar terms over 5 years, 10 years, 20 years, 30 years at 5%. That's China. Whether you look at the Hong Kong market or the Chinese mainland market, 5% compounding dollar is all you get. And yet, they've been spectacularly successful in attracting 5x, 6x the FPI money that we have received. They've been spectacularly successful in selling the stock market to their public, right? So it's two sides of the same coin. Our lack of ability to convince our own population, the RBI says 95% of household savings is in physical assets. Our lack of success in persuading our own population, our lack of success in pursuing FIIs is not because we have crap companies or a crap stock market. To the contrary, our companies generate far more cash flow than the Chinese and we compound better. Our lack of success is a public relations failure, and hopefully, courtesy stellar work by folks like Mr. Desai, that PR failure will soon be addressed and the Chinese stock market will end up, China's FPI flows will end up being where they belong and the decades-old imbalance will be redressed.
Kenneth, as an old seasoned investor, how much of this is in the price already? All this bullish talk that we're hearing today.
So you have to construct a portfolio, okay? I typically look at it from a perspective that you could get an entire portfolio between 10 times. You have to go for a very different part of the market to actually do that, but it's available. But just to add to to what's already been said, there are a couple of pointers that I'd just like to point out why 2000, this decade is a little different, right? Step back into 2000, 2010, or even before that, and sometime after that, India exported because you needed the dollars. Now, when I just look at it, we've got IT, which is a net exporter. We've got pharma, which is a lowest cost producer and a net exporter. 52% of all pharmaceuticals manufactured in India is exported. We are very large in agrochemicals across the entire world. We are the net exporter of intermediates right now. If you look at automotive, okay, surprisingly, almost 25% of all automobiles produced in India is getting exported to an extent. Then you look at smaller industries like aquaculture, etc. That's all there. And all these utilization levels are at between 75% to 80%. So you got spare capacity and you got lowest cost manufacturers in India, including the steel, including metals, which is the steel, which is a large part. Now, this is what's happening on manufacturing. Okay. And I can't quantify this, but if I had to say this, India is 3% of world GDP. We probably be 3.5% of manufacturing capacity, 3.5% of manufacturing capacity compared to what's there outside the world. Now, this is a debt-free balance sheet, which is where corporate India is. Take 1999 to 2022, India's debt equity at the corporate level is sitting at its lowest that you've ever seen in the BSE 500 companies, and that's, my sense, is around 30% of India's GDP. So that's the asset side. If I flip over to the liability side, you're coming out of a huge bear market in corporate lending. Okay, you tabulate the banking balance sheets, and today an average of 28% of the banking balance sheets or the corporate side, which is essentially PSUs, is sitting in investments, which is the leverage that you got on your financial side. So all we need is demand. We've got capacities, we've got the cost structures in our favor, and if we can get the growth, we can leverage that growth. Frankly, in my investing experience, while India has been an off and on cycle that you've seen, I haven't seen a formation of the cycle ever take place. So markets, headline, expensive, driven by a lot of companies that probably belong to a subset of businesses that got extrapolated over the last couple of years. The opportunity, should demand environment stabilize globally, I think we will feed into the rest of the world and do it very successfully in this cycle.
Right. Devina, you've been at pains over throughout your investing career, particularly the late part of it, to say that the India story is good. You invest in it yourself. But it's never a good idea to invest just in India. You should have exposure to other kind of assets and other kind of geographies. Can you tell our audience why you believe, if the India story is so compelling, why do you need to look elsewhere?
Yeah. So for one, if you look at India, India is what? It is 3.5% thereabouts of the world market cap in equity markets. So what would be the reason to put 100% or 90% of your assets in a single geography? Every country, investors have a home country bias. Canadian investors have 60% of their assets in Canadian equities. Canada is not 60% of the world equity markets. But in India, that is very, very pronounced. And part of the reason is that historically, we did not have capital account convertibility. Most of us in this room would remember a time when you could take out only $500 once every 3 years. So while now the liberalized remittance scheme allows you very good amount, 250,000 per head per annum, which means in a family of 4, that's $1 million. People have still not really gotten around to thinking about global investing, or if they think of global investing, they think NASDAQ ETF le liya and that's enough, which is not global investing. True global investing means looking at all geographies, all asset classes, and there are a few reasons for that. And I will go back to my personal history, which was the Asian crisis approximately 25 years ago, when in just 1 year, in dollar terms, the markets fell between 50% for Taiwan to 90% for Indonesia and Thailand, South Korea, everybody in between. And, we talk of the India growth stories. These were not basket case economies. These were the Asian tigers. India wanted to be an Asian tiger. You wanted to grow at those growth rates. And yet, if you were an Indonesian investor, you would have seen your net worth wiped out by 90% in a single year. For me personally, that was a wake-up call. So 1999, we were the first Asian firm to become members of the London Stock Exchange, because I said, it's no time to be in a single market. And then the next year of the NASD. So that is where, crisis is one thing, but even without a crisis, when I started working in the 80s, the dollar was 12 rupees. Now you know where it is. So it's a 85% depreciation in the course of less than a single career. So when we talk of long-term planning, long-term financial goals, long-term asset allocation, you have to look at global investing. And that means over a period of time, at least 30% of your, if not more of your assets should be global. And more so now, most people in this room would have children studying abroad or planning to study abroad, or therefore children settle abroad, maybe you even want to retire somewhere else. So those are all considerations you have to take into account. The old adage of not putting all your eggs in one basket, it is as simple as that. So while I say India will outperform, but this is not something I'm saying with a one-year perspective, but longer term, you have to look at global investing. And again, if you just buy a single other market, even if it's the largest market, which is the US, that is improving things slightly, but that is still not global, because leadership changes in 2021 when there were all these NASDAQ ETFs and funds being launched. I was trying to tell people that this is recency bias. 3 years NASDAQ has been a great performer. You think it will last forever? Nothing lasts forever. No theme lasts forever. As I said, 2003 to 2007, we heard all these stories that US is over and now it's the decade of the emerging markets. 2010 to 20, when US was performing, those stories were forgotten. You might hear those stories again. But those are no theme, as I said, whether it is geography, whether it's asset classes, or within a country, the sectors, no theme lasts forever. So that is something you have to keep in mind. And 85 to 90% of your returns, first page of Investing 101, come from your asset allocation, not from security selection. Whereas we spend all our time talking about security selection, which is the next multi-bagger, but get your asset allocation right. And that includes global diversification, true global diversification.
Ridham, I know you believe that India has been and will be the best performer among countries, but would you concede that there is a strong element of cyclicality that Devina is talking about? Or do you think that India is a far more structural bet than that?
I can't dispute the point that she makes. It's absolutely valid, which is from a portfolio perspective, diversification is key. You can't put all your eggs in a single basket. Unfortunately, I don't think most people have the expertise to go so diverse. So you'll have to rely on professional fund managers, and as she pointed out, people just go and buy the ETFs, because imagine selecting stocks in India itself is a tough job. Now imagine selecting stocks in 25 different geographies, or doing other asset classes. So all these requires a lot of deep expertise.
But there are lots of products which are being launched.
Yeah, so you'll have to then go and buy products. I don't think there's much dispute on what she's saying. It's absolutely spot on. I mean, it's like putting all your money in a single stock. Is that good investing? No, it's not good investing. So single geography, single stock, single fixed income asset, all of these are risky strategies. Now, of course, I do what I do the best, which is, understand Indian equities. There also sometimes I doubt whether I understand everything correctly, but, that's my field of expertise. So I stick to that, but I can't dispute what she's saying.
Saurabh, you're a proponent of concentration rather than the kind of thought process we are hearing now, right?
So I think both concentration in India and concentration abroad. So courtesy the 18 years that my wife and I lived in London, we got 1/3 of our money abroad. And that's a concentrated portfolio of, again, very similar to what we do in India. We've invested our savings from our 18 years in the UK in global monopolies, companies whose products many of you are using, even as I talk to you, many of you are using some of the global monopolist product, high ROC, dominant franchises, compounding in dollar terms at between 15 to 20%. And similarly in India.
No, feel free to mention names as well. We are in a small crowd of friends.
So similarly in India. So if you take, say, an Apple or a Microsoft, I think Microsoft has been compounding at 15 to 20% now for the best part of 30 years. Just when I was starting to worry, because, I've also been told by lots of people that you should constantly worry, even if you've invested in a great company. Worry is the name of is what you should do as an investor. Just as I was beginning to worry, they thankfully went and bought ChatGPT, right? So I'll worry a little less. But jokes apart, the global portfolio that my wife and I built is very concentrated. Similarly, the Indian portfolio that we keep harping about is very concentrated. By the same token, we have a small cap portfolio in India, similarly concentrated. And the sort of the creed I'm espousing, the story that I'm trying to convey to you is, as I think Robert Hagstrom wrote in the Warren Buffett portfolio in 1994. Robert Hagstrom wrote a remarkable book called The Warren Buffett Portfolio in 1994. He conveyed the point of view, Buffett's point of view, John Maynard Keynes' point of view, that in any country, you will have ups and downs. The business cycle is a permanent feature of modern economic life. In any country, you'll have ups and downs. But if you want to consistently compound your wealth, whether in America or UK or India or Japan or the Middle East, build a concentrated portfolio of high quality stocks and stay the course. Don't try to second guess the market. Don't try to pretend that you'll be second guessing Nifty kahan jayega, Nasdaq kahan pe jayega. If you build a portfolio of concentrated high quality monopolies at the global level, as Devina is saying, and at the Indian level, as we do, even if you do one of these two, you'll be fine. But I think what's devastating for most people, so my parents' pension in the UK, by the way, is run by one of these fund managers. That fund managers bought lots of tracker funds, and my parents' British pension. And these poor guys, right? Just imagine my parents' plight in UK. They've been retired for 10 years. Inflation in UK is 8%. Their pension portfolio compounds at 2%, right? And this is happening to millions of families in the Western world, right? They're being ravaged by their fund managers buying ETFs, pension funds buying ETFs, at a world where inflation is 8%. Now, the result of that, Udayan, is very interesting. If you see Nifty VIX, Nifty volatility is actually lower than S&P 500 volatility now for the last 5, 6, 7 years. And the reason for that, I suspect, is because America has become such an ETF market, active investor interest has diminished, which makes that market volatile when new information emerges. Our country, for better or for worse, hasn't yet got as ETF'd as America. The result that they're going to suffer from for many years to come unless there is enlightened regulation in America is the American market steadily becomes more volatile than ours. And that's where having a focused portfolio of high quality global names, Indian names, puts you in good stead. If you're living in India, carry on buying stocks here. But the mantra I have taken is 1/3 global, 2/3 Indian. And so far, Udayan, in the last 2 years, my better half and myself have done just fine out of that.
Okay. Devina, this morning, when the first session, I asked the same question to Samir Arora, and he almost thumped the table and said, concentration is the biggest enemy of your portfolio. You seem to agree with that because you own more than 50 stocks in your portfolio. Saurabh has only 15. Why do you think that one should have a far more diversified portfolio?
Well, that's what the statistics show. I mean, people tell me that you picked Amazon at $12 and you picked HDFC Bank 1 year out of IPO. Tell me the next HDFC Bank, I want to buy it for my son or daughter and keep it for 25 years. I said, nobody has that crystal ball. If you did, you would find investors in the world who have invested, if not 100% in multi-baggers, 90%, 80%, some number like that. There is nobody who has done that. Warren Buffett says that if you take out my 8 best bets in 60 years of investing, you will find that I have underperformed the market. Because you cannot know upfront which are going to be those stocks which compound at those levels. If you would ask Jeff Bezos or Aditya Puri, they could not have told you that. So the only way to do this is to have a portfolio of at least 25, 30 stocks, chosen with care, with a system, and yet you will find that some of them will turn out to be duds. So as I say, first thing one thing which will really help your portfolio is that when you're making a buy decision, tell yourself, I may be making a mistake. So that you don't stop yourself from acknowledging a mistake if that is the case. So if you buy 25, 30 stocks, yes, if you've chosen them carefully and if you are lucky, you will find 2, 3, 4, 5 which have done, which become multi-baggers. But do you know upfront which are those 5 and therefore you can buy only 5? No. And in a concentrated portfolio, also typically I find a lot of people when they talk concentrated, it's not just the number of stocks.
Carry on.
Hello? Yeah. So then don't just buy 15 stocks. They buy it only in 2 or 3 sectors. So effectively, you do not even have that diversification to the extent of 15. Because those sectors move together, and as I say, no theme runs forever. Any theme you want to put, businesses and stock markets are 2 different things. You can pick up any sector and you will find stocks in the steadiest sectors which have not performed for 10 years, 15 years at a time. So that you have to take into account. And we believe in sectoral diversification. We believe in diversification in terms of securities. And we have backtested it. And always also remember that investing is a loser's game. So first thing you have to make sure is that you reduce volatility, you reduce drawdowns. That's what we tell our investors also, that 60% of what you pay us is for risk management, 40% is for return management. So ask your fund manager or financial advisor, what is your risk management strategy? Because the only way to win in this game is to make sure you don't lose big. So every conviction has to be held very lightly.
Kenneth, which of these two schools do you belong to? By the way, when you started your first answer, I think they're all cursing me because you started by saying, you can build a high quality portfolio with a 10 to 15 PE. And they said, okay, what next? And you proceeded to something else. I think that's the part they're interested in.
Okay, I've been on both.
Little louder, Kenneth.
My investing experience actually got built through through what Peter Lynch wrote in all his books, right? So one way to outperform indices is there are two ways to outperform indices. One, you build a portfolio outside the index, so you take the breadth of the market, and the second way to do it is concentrate within the indices itself. Okay, and both work. So I've had colleagues and I have a peer group who've done extremely well for a long period of time, and everyone has different styles. I think you've got to pick the style that works for you. Okay, and the longer you keep doing it on that style and the number of stocks that you're doing, I think you will just, over a longer term period, you'll stop making mistakes. Like Devina says, you stop making mistakes and let the winners run. And that's how we do it. So my sweet spot is anywhere between 20 and 30 stocks. That's a lot. That's 50% more, but that's a sweet spot that we are in. Okay, so that's a little bit of the concentration paradigm that I've come across.
Okay. Ridham, I want to ask you about, there's a final session this evening about how to generate alpha. But since you're not going to be there for that section, I want to touch upon what Saurabh said earlier about ETF investing. Because the strange phenomenon is that India did very well relative to other markets in 2022. But 60% of the funds in India actually could not beat the index. All the PMSs and mutual funds did far worse than the index. How do you, we know why it happened, but what's the way around that?
So, Udayan, that's not a 2022 problem.
Perennial problem.
That's a perennial problem. I think Devina mentioned this, that picking a 10-bagger or a 100-bagger, knowing that in advance is very hard and almost impossible. Likewise, picking a fund manager who's going to outperform in advance is a similar exercise, and it's not really possible. And I think it was in the 1994 Berkshire Hathaway AGM that Charlie Munger, in response to a question about how to invest, said that unless you have Warren Buffett's skills, just buy index, right? And the index investing has boomed in America as a consequence of the fact that it is very hard to know in advance which fund manager will do well. And this actually goes back to this whole concentration and diversification debate. It is all right to concentrate so far as you have the skills and, more importantly, the stomach to sit through it. I mean, what Saurabh has, which a lot of us don't have, is a lot of stomach. I mean, he can sit through that volatility that a 15 stock or a 10 stock portfolio will suffer. If you don't have that stomach, and if you're prone to making mistakes, when your stomach starts grumbling and you start feeling uneasy, then you have to do what Devina is saying, which is buy a well-diversified, geographically, sectorally, asset-wise, which will not go through those drawdowns that, concentrated portfolios go through. So I think that's where the concentration versus diversification debate lies. There is nothing right or wrong. It's just about your own, what is your own character? What is your own character? Do you have the ability to sit through the extreme volatility that concentrated portfolios tend to suffer from? So going back to your question, it is as difficult picking up the winning fund manager. So if you don't have the stomach to go through that underperformance, then you have to do what Devina says. And if you can go through it, then, fund managers bounce back, just like markets bounce back, just like stocks bounce back. So those who underperformed in the last 2 years will likely outperform in the next 2 years. Only thing is we don't know who. And on the question on ETF, I think Saurabh alluded to it. It's a pretty scary thing out there, because I think now 40% of global equity assets are sitting in ETFs, and they will produce anomalies on valuations and prices, which will be, of course, mouth-watering for active fund managers. But while that process is on, it's not going to be a very easy process to deal with. And one of the reasons why active fund managers suffered in 2022 was as a consequence of this phenomenon. It's starting to happen in India. It's building momentum. ETF is gaining size. In fact, it's gained, I think if I'm not mistaken, it's up 25 times in the last 5 years.
Wow. Saurabh, what is this fair amount of stomach that your investors or any investor should have? Because it is normal for fund managers to go through years where they will underperform. And it's normal for fund managers to say, in the long term, I will make good. But as a fund manager, what should you tell your investor that give me these number of years, and if I'm still underperforming, then something is wrong?
So I think that the stomach piece is exactly the heart of this, right? So just to sort of take the first inference from the stomach piece, because this is tough, because running concentrated portfolios even in America is tough, you don't have too many Warren Buffetts or Rowan Cunniffs or Lou Simpsons and so on, right? The concentrated investors, even in a giant market like America, are few and far between. And as everybody on this panel is saying, America is getting ETF'd. And as America gets ETF'd, the inefficiencies are greater, right? There are fewer and fewer active investors applying their mind. That means the opportunities for concentrated portfolios are greater. But as everybody is saying, you need stomach to do this. Now, let's understand, what do we mean by stomach? What we mean by stomach is as follows. If, for example, if everybody in this room has seen that for 30 years, Pidilite has made white glue, and white glue has sold, and Pidilite, I think, has compounded free cash flows at 25, 27% for the last 20 years, naturally, everybody in this room will infer that Pidilite will continue compounding cash flows, say at least for the next 10 years, right? So Pidilite becomes like a long government bond, 10-year government bond. The expectation from most people in this room will be, Pidilite's done this for 30 years, they'll do this for the next 10, and let's therefore treat it like a 10-year government bond, steady cash flows for at least 10 more years. In contrast, if Coal India hasn't grown free cash flows, or actually hasn't had free cash flows many years, and those free cash flows don't grow, nobody expects Coal India to be growing cash flows for 10 years. Perhaps people expect it to grow cash flows for 2 years. It becomes like a 1-year, 2-year government bond. Now, in that circumstance, if you bang up US interest rates by 4%, naturally the company which has got greater growth embedded in it will correct more than the company that has less growth embedded in it. Coal India or a Power Grid had less growth embedded in it, it will correct less. If you have, like we do, a concentrated portfolio, it will fall more than a portfolio made up of, as everybody here is saying, a mixture of things. If I had Power Grid, Coal India, public sector banks, it would fall far less, because the embedded cash flow growth will be, the expectations will be far less. Now that we infer is an opportunity. Effectively, if you see our portfolios, profits are up 20-25%, EBITDA or cash flows are up 20-25%, but the share prices are down 20%. As everybody is saying, that's a challenge for the stomach, right? So I've had to have lots of or digestives to deal with the fact that my profits are up, EBITDA is up 25%, share price is down 20%. And all we have to do then, in inverted commas, all we have to do is tell our clients, what do you want to do? Do you want to follow share prices through the rest of your life? Or do you want to follow companies whose profits are rising 20-25%? In fact, in our small cap portfolio, EBITDA is up 35% first 6 months of the year, although share prices are down 15%. What do you want to do? Do you want to invest in companies whose EBITDA is up 35, share price down 15? Or do you want to follow Coal India, Power Grid, State Bank of India, which is a perfectly valid way to invest? That's a perfectly valid way to invest. Our point of view to our clients is follow the companies who compound cash flows consistently. Yes, you will have rough years like the last 12 months, but that's the nature of the beast. If you didn't have those rough years, then everybody would do what we do now, right? And therefore, that is the balance, the perpetual debate in investing. Do you want a basket which has got everything in it? Coal India, Power Grid, State Bank of India, Bank of Baroda, and Pidilite, Titan? Or do you just want the quality stuff? If you just have the quality stuff, you will go through rough periods. In Hagstrom's book and in my practical experience, out of 3 years, you'll have one rough year, right? Typically, sometimes you have longer, but typically out of 3 years, you'll have one rough year. But that's the price you pay for superior performance in the long run. If we look at America as a whole, and if we say the Indian market will one day end up like America, the American public is saying we have no appetite for trouble. We want the whole stock market in our portfolio, hence the rise of ETFs in America. And perhaps if we end up like that, then people like me will have greater anomalies that I can profit from. But yes, as Ridham and Udayan are saying, we will have a bumpy ride along the way.
You can hardly blame the Americans for not wanting trouble. They had Trump for 4 years.
It's a valid point.
Kenneth, the other thing which keeps coming up in conversations this time, I'm sure it comes up in conversations with fund managers like you, is you had a year where most funds delivered low single-digit returns. Fixed deposits are giving you 7-8%. Fixed income is looking quite attractive as we enter this year. Can you promise returns superior than fixed income in the foreseeable future?
Well, that's going to be one of the biggest challenges for equity, right? And I don't know about 1 year, but over a longer term period, that number is certainly quite okay. Delivering over a high yield over fixed income, that's certainly okay. Because if you look at most of the established portfolio managers who got more than a 10-year track record and are still around in some format, they have done in excess of 13 to 15% of CAGRs through that entire period. Near term, that challenge exists. I think it's a great time for investors. So apart from just saying that equity is the only thing that you need to invest in, though I'm an equity manager, I think fixed income gives you an enormous opportunity.
Please.
The debate is actually not about fixed income. In the last 5 years, 4 out of those 5 years, the top performing asset class for an Indian investor has been gold.
Gold, I know. But gold is such a bad word for people like you, I dare not mention it.
No. That is one that begs attention, because if you look at it from a long-term perspective, again, going back 25 years, yes, the Sensex has been the best performing asset with a lot of volatility. Gold has come with lesser volatility and lower returns, but it doesn't fare so poorly. No. Fixed income, which is fixed deposits and the treasury, and surprisingly even property, has done very poorly compared to gold and equities. So I think the debate is this, another year for gold.
Devina?
I'd just like to add to that. Gold, if you look at from about 83, 84, for 20 years gave zero return. So nothing is, as I said, no theme runs forever. You can't say that I'll buy gold and that will be a steady asset. It is not depends on when you buy it, at what price. If you look at Warren Buffett, best so-called investment, Coke, which she's been talking about forever, for 30 years from 1993 onwards, it underperformed the S&P, underperformed Pepsi by a huge margin, but by having sort of associated so strongly with that, having told that story so many times, he continued to hold it. So no theme ever runs. So, which is why asset allocation, have some asset allocation in gold and obviously always in fixed income. I tell even young people that don't put 100% in equity. You don't know when you will need some money. All your money cannot be locked away for decades at a time. So think of asset allocation always.
Ridham, finally, admitting that India is looking very good and the best it's looked in a long while, there can always be accidents. This Devina's thing about what happened with the Asian tigers, what in your eye can go wrong over the next 5-6 years? Because things have a habit of going wrong sometimes.
Many things.
Yeah, but one or two which come to mind.
Take another 40 minutes.
No, one or two, quickly, one or two.
Okay, so we have to still deal with an election in 2024.
Do you think that could throw a surprise?
No, I was discussing with Rahul. It's the Indian electorate. It's not the most predictable thing on the planet. It has done funny things in the past, so we don't know. We have a very tricky geopolitical situation. I mean, our neighborhood is in crisis. Not a happy thing to be in. You don't want your neighbors to be in crisis, and most of our neighborhood is like that. I think we still have to deal with a world that is aging quite rapidly. I mean, note this year, China's population will decline. That hasn't happened in the lifetime of most of us, where a country of the size of China will see a declining population. Demographics is not a Chinese problem, it's also a European problem, to some extent a US problem. What does that mean? It means that the world is slowing down. When China was putting up all this manufacturing capacity 25 years ago, it had a lot of tailwind from global growth. India will not have that, and India's exports to GDP will keep rising if we want to become richer. And as we install more and more manufacturing, we will need a more stable world. So that could be a thing to worry. We still have to worry about skilled labor. Yes, we want to set up all these factories, we want to get all this FDI, but our labor is likely not adequately skilled, and those gaps need to be filled mostly by the market, but those gaps are there, and that may create volatility in wage costs. So there are quite a few things to worry about. It's not going to be a straight line. It never is a straight line. There'll be fair number of ups and downs, but on a relative basis, I think this is as optimistic as you can get on India on a 30-year time scale.
Devina, what is the case for the story which had enormous promise but went wrong? For India, I mean.
A demographic dividend? Because see, the demographic dividend has three parts. There is what proportion of your population is in the working age, into what percentage of that is actually working, into the productivity. So we have the first bit, which is that a large working age population, but we have that for a limited period of time, just as every other country in history has had. But we have not been able to find employment, even pre-COVID, our unemployment rate was at a 40-year high. Unemployment is even higher among the young. So that is what worries me, that you will never get that demographic dividend actually show up in the economy, because you're not able to employ those people. And that employment drives things at both levels. One is at the output side, manufacturing or services, as well as then therefore that per salaried person consumes stuff and therefore drives demand for everything else. So that to me is that we'll miss that bus. That to me is the biggest worry. And which also ties into education, health, especially after the pandemic when children have lost 2 years of schooling. Because if you don't invest in education and health, you will have a next lot of unemployable people. So for, whether for the budget or longer term policy, those have to be the focus areas: employment, education, health.
On that note, thank you very much, all of you, for joining in today. Thank you very much indeed.